This market leader trades at just 7 times earnings. Keller Group Plc is the world's largest specialist geotech contractor, and shares are up 30% over the past 12 months. At the current price, Keller has a market cap of £1 billion and an enterprise value of £1.1 billion. Revenue over the last 12 months comes to £3 billion with £142 million of net income, £289 million of ebitda and £177 million of free cash flow. The company trades on the London Stock Exchange and pays a dividend around 3.6%. Keller Group provides geotech services that include foundations, ground improvements, piling and monitoring. They make sure ground is suitable and ready for building, which is an essential part of any construction project. The company has grown steadily over the years by acquiring smaller geotech companies and expanding into new markets. As a result, Keller has built a highly diversified and profitable company. 60% of revenues come from North America, 27% from Europe and 13% from Asia Pacific. Revenues have expanded 10% a year since 1994. Operating profits have increased 11% a year and dividends have grown 9% a year. And the geotech industrial market is expected to grow at least 6% a year going forward as construction projects become more complex in urban areas. If there is a question about Keller Group, it's why the stock is so cheap. The most likely explanation is economic and political uncertainty. Trade tariffs and cuts to government spending in America are causing analysts to downgrade economic growth. This issue is prevalent for Keller Group because 90% of operating profits last year came from the US, and 30% of Keller's annual revenues are attributed to infrastructure and public buildings. As a result, management said they expect a moderation in operating margins in 2025, which is another way of saying profits are likely to decline, and it wouldn't be the first time that Keller has undergone a cyclical slowdown in profits. Even so, Keller should see improvement in Europe, and the group still has a record order book of £1.6 billion. If you project a simple discounted cash flow model that anticipates just 4% annual growth for 10 years, with free cash flow margins of 3.5%, the fair value works out to just under £21 a share, which is over 50% upside from the current price. So Keller Group stock looks too cheap on a long-term horizon. After all, this is a good business with solid fundamentals. However, a normalization in the US segment this year does weaken the case for significant upside. But these are my personal opinions, not financial advice, and I hold no position in Keller Group. For more investing videos, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.